Welcome to Trading Pro. Today, we're going to learn about the 3-drive wedge reversal, which is a fairly common pattern in the market. Sometimes, actual examples might not be particularly clear, or the pattern may not be entirely standard, which can make it difficult to identify. However, as long as it resembles a wedge, we can trade based on the logic of a wedge pattern. Before we begin, I want to emphasize once again something that I highlight in every video about reversal patterns. Market movement has inertia. Once a clear trend has been established, most reversal patterns are likely to fail. More likely, they are likely to form a trading range. Only a small probability will bring a trend reversal through a counter-trend breakout. Let's first take a look at a few examples of 3-drive wedge reversals. A strong movement is followed by 2 slightly weaker pushes. Although these 3 pushes don't form a converging wedge, their meaning is the same. Breaking through the trend line and moving averages, and having a pullback from a high, followed by a counter-trend breakout, eventually reversing trend. Some of you may have noticed that this example could also be traded as a major trend reversal pattern. Recall the conditions for a major trend reversal that we discussed last time. A strong breakout through the trend line and moving averages, a pullback to the original trend extreme, and then a significant counter-trend breakout. This pattern can be traded as a 3-drive wedge or as a major trend reversal, and either approach would be completely fine. The focus of our study of price action is to perceive the change in the balance of power between bulls and bears from the price pattern, and the pattern itself is secondary. Let's take a look at the second example. There are 3 distinct downward pushes, and the trend line and channel line show a converging pattern. This is a standard 3-drive wedge, which is relatively easy to trade. Now let's look at the third example. We might not even know what pattern the market is following, but we can clearly see 3 main pushes. Some patterns are just like this. They're very messy and hard to judge during the process. In this case, we wait for the market to complete the pattern, then look for a second opportunity to enter. For beginners, just trading the most obvious and simplest patterns is enough. We are learning technical analysis to make money, not to master all the complicated and difficult to understand patterns. Now let's talk about why a 3-drive wedge is likely to lead to a reversal or a deep pullback. Let's use an example from the Bitcoin daily chart that we are very familiar with. The 3-drive pattern that we trade best is a strong push, followed by 2 weaker ones. Why does this pattern represent a weakening of trend momentum? It's quite obvious because the breakout in the direction of the trend is decreasing. Why does a smaller breakout represent weakening trend momentum? Because in a healthy trend, each breakout should bring new entry force to propel the trend. When the breakout is significantly smaller or even fails, it represents that the trend followers are no longer confident that the trend is running healthily. They worry that entering during a breakout will not bring profit, so they start to sell and square up, preparing to re-enter at a better price. When the trend momentum is significantly weakened, the market will face a deep pullback, enter a range, or even reverse the trend. How to trade a 3-drive wedge? Actually, we've already talked about how to trade a wedge in the pullback section. It's the same here. The first method is to enter a trade at the channel line, because when we enter at the channel line, we have a great price advantage. The risk-reward ratio is very high, and the mathematical advantage is excellent. Therefore, the trading opportunities will be few, as the market won't often provide us opportunities to enter orders at the channel line. When I trade myself, I often wait for the chance to enter orders at the channel line, or I wait for the price to break above the channel line, then show a false breakout signal, and then I enter the trade. The second method is to enter the trade when the trend line is broken. I seldom do this and don't recommend it much either. As we already know, most trend reversals will test the extreme value of the original trend. If you enter directly when the trend line is broken, your position might suffer a floating loss during the test of the trend extreme value afterwards, which can be quite uncomfortable. There's only one situation where I would enter directly when the trend line is broken, and that's when the wedge has become very narrow. Suppose the market forms such a wedge and the price moves to this point. I would directly enter when the price breaks down. Why? because the stop loss for entering at this time is very narrow. Assuming the price breaks down here, the stop loss can just be placed above the channel line. Such a stop loss space can be accepted. The third way to enter the market is during a breakout retest. In reversal patterns, why does the price often retest the extremes of the original trend after a significant breakout? We discussed in the last video that the main participants in the market need to see the trend direction weakening during this retest. Only then will they enter the market against the trend. A retest entry is often referred to as a second chance to enter the market. The previous strong counter-trend breakout was the first opportunity to enter the market against the trend. The difficulty with this entry is that you don't know how far the price will retest. Take this case for example. The height of this retest is still not high enough for me personally. Even though I know there's a high probability of a drop later, I wouldn't participate in this trade. Different traders have different trading styles. For some people, they subjectively believe the trend has already reversed. When the price pulls back close to the previous high, they start to enter the market in batches to short. What entry method you choose depends on whether you're an aggressive or conservative trader. No one can give you the right answer. Now, let's talk about the profit target of the triple push wedge. The first target is the starting point of the second push. In general, when the price moves to this point, you already have a considerable profit. You can close half of your position or close it all. This position is also where the trend might re-enter the market. The market may re-enter the oscillation range because if the trend enters, both bulls and bears will compete again. The second target is the starting point of the first push. If the price moves to this point and you're still holding a position, you should have gained a substantial profit. At this point, you should close out all your positions. We've discussed the trading logic and entry-exit points of the three drives wedge pattern. Let's look at some examples. Look at the first example. The three pushes show weakening momentum. Only in a few cases does the market give us a perfect wedge. In most cases, it's not standard. We mainly observe the breakout situation of the third push. I've marked the horizontal positions. Before this candlestick came out, we couldn't determine what state the current market was in. But when this candlestick closes, these two candlesticks form a double candlestick reversal, and there's also a false breakout of the previous high. At this point, we know that this triple push wedge may be established, and we can consider shorting. But this signal candlestick is too long. Whether you enter directly or place an entry order slightly above it depends on you. In addition, you can also pay attention to the breakout of the trend line and the breakout of the previous swing low. You can use the breakout entry pattern we taught. If you make a breakout entry, I suggest you choose to enter at the breakout of the horizontal swing point, because the validity of horizontal support and resistance is far greater than the inclined trend line. Look at the subsequent trend. The price chose to break down and successfully reach the first target position, which is also the starting point of the second push. Note that this target position is not an exact point, but you can close your position and take profit when the price is near this area. Unfortunately, there was no second chance to enter the market. The market did not retest the extremes of the trend, so traders who make breakout retest entries did not participate. Look at the subsequent trend again. Although the price got some support and reaction at the first target position, the bulls didn't ultimately take the initiative. The price continued to fall, reaching our final target for shorting. After a climax reversal, the price resumed its upward movement. Let's look at another case. This is a very standard three drives pattern. The first push, the second and third pushes. Because the pattern is very standard, trading it is relatively easy. Whether you enter the trade with a limit order at the channel line or enter at the time of the trend line breakout, there are no issues. The first target is the starting point of the second push. In most cases, you can close out all positions at the first target, or at least half of the positions, because this location has already given us a very large profit margin. Here, I'd like to remind some novice traders that when they see a big move in the market, they feel that they must catch it. And if they can't catch it, they feel very uncomfortable. But sometimes the market doesn't give us a good entry point, even if you know it's going up or down. If the market doesn't give you an entry pattern or an entry signal, my advice is to follow the system. If the system doesn't give you an entry signal, don't mess around. If you trade the breakout of the trend line, such as breakout, pullback, and then breakout, that's also okay. Standard wedge trading is very easy. Basically, it's a gift from the market. We can see that the first target was quickly reached afterwards, and in this trade, the final target was also reached. Today we have talked about many successful cases, but don't think that reversals are really that easy to do. As I also mentioned at the beginning of the video, the success rate of all reversal patterns will not be very high. Please remember that we have found that most patterns, whether they are pullbacks or reversals, can be divided into these three types of entries. The first is limit order entry, also known as left-hand entry, predicting the future trend of the market in advance. The second is breakout entry, directly entering at the time of a key level breakout. The third is the breakout retest entry, which is what we often call right-hand entry. That's for today's video. And if you like this content, please like, comment, and subscribe so you won't miss out, and I'll see you in the next video.